Hello and welcome to our weekly quick strategy video. I thought this week we go back to basics a little bit. Right at the beginning, I was talking about trends and how traders will use trend lines to try and identify, is the market going up, is the market going down, and position themselves accordingly. It's one of the most famous market quotes is, "The trend is your friend." We should all try and trade with the trends. If the market's going up, we want to be a buyer. If the market's going down, we want to be a seller. But I think for many people, this is easier said than done. And I think it's human nature that if a market's going up, too many of us try and pick a top. And of course, if a market's sliding, too many of us will try and call the bottom. And that can lead to plenty of losing trades. I thought this week we'd look at a different twist on the idea of trend lines. So traders and investors will use trend lines to identify which way the trend is and a good point to get in. And according to the textbooks, if a trend line breaks, that's it. The trend is over. But that is not necessarily the case. And a break of the trend line can give us a good opportunity to get in on a low risk, high reward trade. So let's take a look at the theory first of all. I think this is something that we're all familiar with, the idea of a trend. The market here had been trending lower, turned around, confidence came back, and the market started trending higher. We have the trend line that's been in place, and the assumption here is that the trend line has been tested again, so the textbook assumption is for the market to carry on higher. But that doesn't happen all the time. Trend lines do of course break, and it's this sort of signal that we're talking about here. So to many people, this would be a signal to sell. But I suggest that in the real world, that's not the case an awful lot of the time, and it can actually end up being an opportunity to get into that trend at a better price. Because the definition of an uptrend in this example is a market that's made higher highs and higher lows. And so far we still have that. This major low hasn't been taken out. So I'd say if you're looking at a trend and you see the trend line break, don't assume straight away that trend is going to reverse, because maybe we're just seeing the trend slacken off a little bit, lose a bit of momentum. But if it holds above the previous low, and we'll look at some real examples in a second. So if an uptrend breaks and it holds above the previous major low, that uptrend may still be valid. If a downtrend breaks but it fails to break through a previous major high, the downtrend might still be in place. So this opportunity here, this is our low risk entry point. It's almost like the last chance for the trend. So if we're buying here, we could put a stop below that last major low and see what happens. If the market recovers, carries on higher, we've got a good reward for potential low risk. But if we do end up getting stopped out, we've got a relatively low level of risk. Okay, so that's the theory of how we can use this approach. Let's take a look at a real market and see how it works in the real world. Here's a good example of the principle from earlier this year. The market we're looking at here is gold, and we have featured this in the past on the vlog. But look at our trend. We've got our trend that started December 2016. The market pushed higher, came back to the trend line, pushed higher still. So we were seeing a good recovery in gold. But then you can see towards the end of April, beginning of May, we saw gold slip below this trend line. Now, that doesn't necessarily mean that trend is going to end. Remember, going back to the theory, we're looking at the previous major low. So let's just highlight that. So we're going to pick on the line here. We'll choose the horizontal line. So it's this low here from in March. There we go. So around about 1195 for gold. Let's jump forward and see what happens next. So we'll roll the chart forward one day at a time. The trend line's broken, but we're going to see, is there any strength ahead of this old low to give an opportunity to buy in? The market does drift a little bit lower, down towards 12.15, but then we see the market stabilize over a couple of days. We can see this here, the strength coming in. So from a low risk buy point of view, if we're buying in here, we've got a stop loss the other side of these lows. And we're assuming that even though the trend line's broken, while this major low holds, the trend is still intact. And of course, the price of gold did recover and very briefly nudge out past this old high. So there's an example in the real world of a trend line breaking, but it not meaning necessarily it's the end of that trend. Just another opportunity to buy in and see if the market continues that trend, but at something of a slower pace. That's the end of our strategy session this week. I hope you'll find it useful. You do see clearly trend line breaks happening all the time, but they don't necessarily mean the trend is coming to an end. It can just mean the trend is slackening off. It's going to carry on in the same direction, but a little bit slower than before. As usual, if you're not subscribed, if you click on the subscribe button there, you'll never miss any of these videos. If you like the video, click the thumbs up at the bottom. And if you'd like us to cover anything in the future, just leave us a message in the comments below. But for this week, we'll wrap things up there, and I hope you have a good trading week.